What's up, everybody? Welcome to Heresy Financial. My name is Joe Brown, and today the Federal Reserve announced that they will not be extending the relief, the break that they've been giving to banks for their capital requirements when it expires on March 31st. They're just going to go ahead and let it expire. Now, this announcement comes contrary to many people's opinions or expectations about what the Federal Reserve would do here, including my own. So in this video, we are going to talk about what it means. Number one, what is the change? What are banks going to have to do now that this is not getting extended? Again, contrary to what many people expected the Federal Reserve would do. And number two, what are the implications of that? What is going to happen or what could happen as a result? Ready? Let's dive in. Last year, the Federal Reserve rolled out a number of things in order to relieve the markets of pressures and kind of help banks deal with the fallout of COVID, where they relieved them of some of the capital requirements. So basically, one of the things that the Federal Reserve said to banks was, hey, we're not going to require that you have a specific amount of capital in reserves compared to your balance sheet. We're just suspending the amount that we normally require you to hold in reserves. Now, this suspension had an automatic expiration date of March 31st of this year, 2021. However, right now, we are currently seeing some things happen in the financial markets that made many expect, especially a lot of Wall Street banks, expect that the Federal Reserve would allow that to go a little bit further, would extend that deadline past March 31st. One of the main things that was causing people to say this is because of the way that the federal government is paying for the current stimulus bill. Over the last year, there has been a buildup up to a height of $1.8 trillion in the Treasury general account. This is like the checking account for the federal government. And this account specifically is held outside of the banking system. But in order to pay for this most recent stimulus bill, $1.2 trillion of this account will be taken and is being used to pay for most of the 1.9 trillion to bring their balance in that account back down to the normal amount, right around 400 billion. This means that there's a lot of new cash entering the system without an increase in the actual number of treasuries. There's not debt being issued in order to pay for this. So the number of treasuries that are out there creating this, what is supposed to be a very liquid bond market, they're not creating new debt for that. They're just spending cash and inserting new cash into the banking system. Now, this is a little bit hard to wrap your heads around, but this is actually hard for the banking system to absorb because deposits for banks are actually liabilities. And so many were looking at the banking system and saying, hey, if the requirement for the reserves that banks are required to have does not get extended, that relief, that lower amount doesn't get extended, then there are plenty of banks that might not have the capital requirements in order to absorb all these new deposits. So many were expecting the Federal Reserve to just push that date out to let banks figure out a way to absorb all these deposits. And again, it's not just individuals. This is all the new money entering the system. Any money the government is spending from this is money that is coming into the system, whether it's going to individuals or corporations or institutions. This is all fresh cash being injected. Now, yesterday there was a big sell-off in bonds causing a big spike in interest rates, which likely means that banks had a little bit of a heads up that the Federal Reserve was not going to be extending this. And the reason why I say that is because treasuries had to get sold to make room to start absorbing some of these deposits. Instead of being able to hold treasuries and receive new cash injections, they have to get rid of treasuries off their balance sheets. Now, over the last 2 weeks, we've seen this start to happen. In fact, primary dealers have shed about $80 billion worth of treasuries just over the last 2 weeks. Now, bonds and interest rates are directly inversely correlated. As the price of bonds goes down, interest rates go up. The price of something then is determined by supply and demand. So when you have the major buyers of treasuries having to dump a ton of treasuries onto the market, that's going to push prices down, which pushes interest rates up. So that's the reason we've seen interest rates been going up over the last couple of weeks. Banks have been preparing for the fact that they can't hold as many of these treasuries on their books anymore because they have to make room for new cash. Now, the Fed is kind of in between a rock and a hard place here because they've been very committed to saying we're going to try and push inflation higher. And they said we're not going to raise interest rates to put a cap on inflation because we think that even if higher inflation numbers show up this year, they're going to be transitory. That means they're going to be temporary. That means the inflation numbers are going to go back down afterwards. So we're not going to hike interest rates to put a lid on inflation. If you remember, the way that the high inflation of the 70s was dealt with was to hike interest rates a lot. And so higher interest rates are a ceiling. They do put downward pressure on inflation. But the Federal Reserve isn't completely in control of the entire yield curve. They're not in control of the entire credit markets. They're close, but not completely yet, which means that as the free market, like banks, start to dump treasuries and dump bonds, dump debt in order to make room for this cash infusion into the banking system, that's pushing interest rates higher, which means that the Federal Reserve at some point, they're going to have to increase the amount of bonds that they're buying in order to make sure that interest rates stay low and don't get too high to the point where it ruins their ability to see the inflation numbers that they say they want to see. Now, that's not the whole story. If you take a look at the announcement by the Federal Reserve, you can see in the second and third paragraph, it clearly gives the Federal Reserve a way out of this. It says, since that time, the time that this was put in place, Treasury market has stabilized. However, because of recent growth in the supply of central bank reserves and the issuance of Treasury securities, the board may need to address the current design and calibration of the SLR to prevent strains from developing that could both constrain economic growth and undermine financial stability. To ensure that the SLR remains effective, the board will soon be inviting public comment on several potential SLR modifications. So what they're doing here is they're basically leaving the door open to themselves to say, hey, if something goes wrong here, we basically reserve the right to change how this thing works. Meanwhile, we also know that a couple of days ago, the Federal Reserve said they're going to continue to be buying at least $120 billion worth of assets to put onto their balance sheet every single month, which means that $120 billion is now the floor. It's not the ceiling. And so if banks continue to have to shed treasuries in order to make room for deposits, in order to make sure that they're meeting their capital requirements, the Federal Reserve has the ability to increase their balance sheet by the same amount. That means they can buy more longer dated treasuries in order to keep yields down where they want them should they see the need arise. So what does this mean for other prices? We know what this means for bond prices, right? Because as banks have to sell a lot of bonds, obviously that pushes bond prices down. Bond prices down, that means interest rates go up. Now, if interest rates are going up along with they're kind of keeping in pace with inflation, that means real yields don't really change that much. Once the Federal Reserve steps in and has to push down interest rates a little bit, suppress maybe even just the growth of the interest rates, that means real yields start decreasing. A reduction in real yields and further negative real yields, that is a bullish force for gold. That is one of the reasons why, especially over the last couple of days, we've seen the price of gold steady, hold strong, even in the face of rising interest rates. It is showing strength against headwinds. As a side note for gold, we know that the bullion banks have drastically reduced their short positions, which means they are far less afraid or less likely to get hurt by a rise in gold prices now because they've drastically reduced their shorts, which means they have no financial incentive now to be slamming the market full of shorts, full of naked shorts to suppress the price simply because they've closed out a lot of their positions now. On net, bullion banks are a lot more neutral than they have been for months. What does it mean for stocks? Well, we know at least for bank stocks, it's pretty negative. A lot of the banks sold off today because the market was not expecting the Federal Reserve to keep the deadline in place. And so this is going to be a little bit more difficult for banks to be as profitable as they have been over the last couple of months. And so this, at least temporarily, is a negative for the financial sector. Similar to gold, rising interest rates, especially quickly rising interest rates, are going to be a headwind for stocks. And so that is one of the reasons why markets have been choppy over the last couple of days. Now, ultimately, the big takeaway here is that it's unclear what things are going to look like over the next couple of weeks. We still have a long way to go before the Treasury general account has bled out that $1.2 trillion that the Treasury is planning to spend out of it. So we have a lot more cash to be injected into the system, and it's unclear how the banks will be able to absorb it. It's also unclear how many more treasuries banks and institutions will need to shed Fed in order to make room for the new cash, which means it's also unclear how high interest rates will go before the Federal Reserve steps in and starts pushing them back down again. So it's very probable that we will see some heightened volatility in financial markets over the next couple of days and couple of weeks, which could very easily give the Federal Reserve the excuse that they need in order to drastically increase their asset purchases, which looks like it's something they want to do, but don't have the public reason in order to justify it yet. And so we will see what happens. At the very least, one thing that we know is that intervention and manipulation in markets down the road causes second and third order effects that are, number one, completely unforeseeable, and number two, require as a fix even more intervention and manipulation in markets. That's why it's all starting to look like one big trade now. Assets either move with or against the dollar, which is basically just every single thing is depending on the word and the moves and the actions of the central bank. It's all one trade now. If you're looking for a way to slowly start to move some of your money outside of the traditional banking system because you see the writing on the wall and you see the issues with the fragility in the current financial system, Bitcoin is one way to do this, and I like to use Swan Bitcoin. They're my favorite way to buy Bitcoin, especially given how easy it is to set up an auto invest and set up an auto withdraw to the wallet of your choice. They're Bitcoin only exchange, which I love. They're not doing any other cryptocurrencies, with highly secure features like two-factor authentication, allowing you to stack sats in the comfort and ease of having it on autopilot and knowing that it is safe and secure. As always, I really appreciate you guys. Thank you so much for watching. Have a good day.